Hi, I'm Roger Montgomery from Montgomery Investment Management, and welcome to this week's Video Insight. In the absence of a plethora of value opportunities, I thought we might talk about something far more ephemeral, and that is a sort of a macroeconomic view of possible future returns from the stock market. Now, I say ephemeral because the reality is that, one, there's no relationship in the short run between economic performance and stock market performance, and two, our views can very quickly change thanks to second order and third order effects, or what might be described as black swan events. So take this with a grain of salt or think about it more deeply. I'll leave that to you. Our personal view here at Montgomery is that we don't know where the stock market is going to go, but we do harbour some views about where it might likely end up. After 600 rate cuts around the world since the global financial crisis and $12 trillion of bond purchases, economic growth around the world remains anaemic. I'd hate to think where the economy might be if not for those interest rate cuts and those bond purchases. But let's think about precisely why neither of those things have stimulated economic growth to the point where we're thinking about interest rate rises or fiscal policy that might be described as tightening. After the GFC, which remember was caused by too much debt, interest rates were cut in an effort to stimulate demand, but unfortunately, when people have too much debt, those lower interest rates fail to stimulate the demand that they were intended to. As a result, quantitative easing was implemented, and quantitative easing was simply the injection of capital into or cash into the financial system in return for the acquisition of bonds from from banks. The impact of this, of course, was very little, and so we've arrived at a point where, after those interest rate cuts and bond purchases, we're effectively pushing on a string. And so now helicopter money is being described as the third policy possibility, the idea that we simply hand governments money in return for interest rate cuts or infrastructure spending. Now, this has worked in Australia, at least. You might remember the school buildings program that was rolled out by the Labor government shortly after the beginning of the GFC, and some say that prevented Australia from entering a recession. You can see in this environment there's very little scope for an interest rate rise. There's certainly very little likelihood of that occurring this year and possibly into next year. Nevertheless, if it did happen, I would argue that it's too early, and as a result we might end up in a situation where economic growth falls off the precipice. So with these things in mind, what does it mean for stock market returns? Well, one thought is low returns are the order of the day when you're thinking about or considering the index. Remembering, of course, that interest rates have been cut in order to stimulate growth, consumption and investment, but the flat yield curve has meant there's very little incentive to invest, and so companies are increasing their payout ratios and paying a vastly larger proportion of their earnings out as a dividend. Investors have chased these dividends, they've pushed share prices higher, but those higher share prices aren't supported by earnings growth because, remember, very little of the earnings are being retained for growth. And so we end up in this situation where the broad indices, dominated as they are by large companies that are paying the most of their earnings out as a dividend, those large company-based indices aren't going to go very far, very fast anytime soon. And while many commentators who are optimistic believe that the market is cheap and it should go higher, one needs to think about this in the context of GDP and also individual company revenue growth and profit growth, which is very, very anaemic. So we think there are some silver linings despite this, and we believe a portfolio of businesses that are growing by 20% or 30% or 40%, such as many of the businesses that we own in the Montgomery Fund, the Montgomery Private Fund and the Montgomery Global Fund, should do better than the broad indices. But don't expect a lot from the indices themselves. We look forward to seeing you again next week, and in the meantime, be sure to follow us on Facebook and Twitter.